Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. With me, I have Chip Kandrak with Gateway Mortgage. Chip is a reverse mortgage specialist over at Gateway, and this is one of the areas that we haven't addressed in quite a while, and I've gotten some inquiries at the office regarding reverse mortgages, so I thought it'd be a good time to do a show and talk about some of the different changes that have occurred in the reverse mortgage industry over the last year, 2 years. One of the things we were talking about just before the break is how you can access that money. So let's say you determine that maybe a reverse mortgage is in your best interest. There are a few different ways. You can take that lump sum where you can get, a chunk of money, and then depending on what your needs are for that chunk of money, maybe you're looking at, if you're looking at, well, in the situation of just using that money to help you pay some things that you need to get paid, maybe you're using a reverse mortgage as a way to pull a little equity out, fix up the house because you're short on cash, and then turn around and put it on the market and sell it. So there's another opportunity, where that, being able to access that maybe a little more easily may come into play. The other is, as Chip was mentioning before the break, is you can take payments. You could take a 10-year payment. So I've talked about annuities many times on the show, of course, and it's understanding how annuities work. A 10-year payment is basically a form of an annuity payment. You can do, when it comes to annuity payments, there are so many different options available. For instance, you could do a 5-year with what's called a period certain, meaning 5 years in life. It could pay you for as long as you live, or at least 5 years, or 10 years in life. So it would pay you either for 10 years or as long as you live. Or you can have what's called a 10-year period certain, where it just pays you for 10 years and then it's done. All right? Now, if you take an immediate annuity where you're saying, I'm going to take this 10-year payment, or you take an existing annuity you may own and you say, I want to trade that annuity, that cash I've built up in this account, for payments, that's exactly what you've done then. Once you've triggered that, now you're locked in. You can't go back and say, oh, I need to get some cash out of this. Once those payments start on an annuitization, then it stays as that. Now, there are exceptions, though. There are annuities where you can, in fact, fixed index annuities are one of these that I've talked about before, where you have the ability, and with other fixed annuities, where you have the ability to take payments, but at the same time without, and it depends on how you do it. Within that annuity, you can either swap your cash for a guaranteed payment and you can't change it, or you can swap it for a guaranteed payment in which you can change your mind down the road. You can say, well, I need some extra cash, and I can pull that out. It's so important to understand what kind of annuity you have and which option you're electing before you do it. And this goes the same, Chip, with your reverse mortgage. So one of the options is you could take this 10-year payment, right? Now this is a 10-year period certain, correct?
So no. So this is a 10-year, T-E-N-U-R-E, which means for the tenure, for the duration.
I see. All right.
So our 10-year payment means you get paid a certain payment for the rest of your life.
So this is a lifetime payment, not a 10-year payment.
Now,
I misunderstood.
Correct. Now the limitation is it's as long as you live in your home.
Right.
And that's, everybody wants to age in place. That's the big thing. They want to have a place to live. They want to age in place. They don't want to live in some little tiny cramped area. They want to live in their home.
My in-laws, that was one of the things.
That's right.
God bless, when they passed, before they passed, a lot of health issues and stuff. Yeah. But one of the things they were very clear about is we want to live. We don't want to have to go into assisted living.
Right.
We don't want to have to go into a nursing home. We don't want to.
That's right.
We want to be able to live out our lives in our home. And a lot of people I talk to feel that same way.
And the good news, Hank, is Medicaid has figured that out finally, and they have programs that you can live in your home and still have access to medical care as well.
Right. Home health care.
Home health care. It's a whole lot simpler now, even with the government, to access your benefits that way.
Well, they're seeing that it's smarter on their part.
It's
a lot less expensive for them to do that than to do. There was a time when it came to Medicaid or TennCare, or accessing monies when you didn't have much money, where you couldn't get. Basically, it was nursing home or nothing. Now the government is coming around to where they're seeing that there are some benefits to them as well, lower costs when they look at assisted living or even home health care as an option. Same thing goes, by the way, if you're a veteran. Aid and attendance benefit. This is another way that you can help cover long-term care type costs, where you can stay at home, where you can access veteran benefits that can provide you, depending on your situation. And this is one of the things, if you're if you or a loved one, your parents, whatever, are looking at this potential of needing home health care or assisted living or nursing home potential looming in the future, and you're not familiar with veterans, so you don't, don't go to the IRS asking for tax advice, is my analogy with veterans. It's the same thing. These are good people. They're going to help you. However, their job is not to show you how to, in fact, qualify. Their job is just to say, you do or you don't. We can show you ways that if you don't now, we can get it to where you can. All right, so it's important to do a little research on this. Get with a good planner that understands the aid and attendance benefits when it comes to veterans benefits, so that you could, you could access as much as $2,000 a month for life. Okay, and this is not a, this is a benefit that you've earned for the service to your country that you've provided, okay, or for your parents if it's for them. And it doesn't, the requirements, just understanding there are some requirements for it that has to do with what your costs are, what your income, assets, as well as, periods of service. So it's something that you want to research, but don't go to VA to find out. Once you've done that and they say no, because you didn't qualify, to go back and try to get it later is going to be difficult. Go see someone that understands it first that can show you how to qualify. So it's the same concept as those benefits are available to help people stay at home if that's what they want to do. And
That's
this
correct.
is where the reverse mortgage has, again, traditionally it's been one of the big benefits for a lot of people.
That's exactly right.
So you're talking about now they can do a 10-year, so it's a 10-year life payment. And that's going to be based on, if it's a couple, how do they do the calculation?
Well, the calculation is based on the youngest borrower,
Okay.
and it's for the life of the youngest borrower. So if at some point the older borrower passes, the younger borrower still stays in the home and still receives the same payment.
Okay, if the younger borrower is the one that passes first, what happens?
It's the same. The older borrower stays in the home and still receives the same payment for as long as they stay in the home. Correct.
Okay. And now you say that can be recalculated. If they took cash out, now if they, let's say they access some cash from the property and they recalculate the payment, if their situation has changed in terms of their age or anything, does that change the calculation, or do they go back to the beginning?
No, the age won't change it. It's just going to be because they're going to settle.
So if they're 5 or 10 years older, that's not going to be taken into consideration.
No, it's going to be based on the original payment.
Right. This is one of the areas then that, again, you want to weigh. So when you, let's say if we're looking at the reverse mortgage and we're considering that payout, and it's just like with anything else, you want to get, you want to compare. So what's going to give me the best rate? Am I better to take some cash out, get an immediate annuity or a fixed index annuity or a fixed annuity of some sort that's going to give me a payment stream, and is that payment stream going to be higher than the one I would get through the through the mortgage company? It's just comparing. Whichever one's the best, of course, that's the way to go. And in making sure that you're comparing apples to apples. If you take an immediate annuity as an example, if you take an immediate annuity and you say, just give me a lifetime payout, that's going to get you the highest payout. That's going to get you the most monthly payment. But what happens? When you die, it's gone. So unless you are a single person that has no other, don't care if the money's gone when you're gone, if there's no other obligations or anybody else you're concerned about, then maybe that's the way to go. However, if you're concerned, maybe you've got a spouse, maybe you've got children, maybe you've got others that you don't want to die a month or two into this and all of a sudden, a couple $100,000 or whatever it might be is gone, right? So you might want to take a period certain, or you may prefer one that says, well, I want these payments, but I also, if I want to go back in and change my mind, okay, and stop the payments and take some cash out, and adjust payments even, then you want to look at all these different options before you make that decision, right? Know what's available to you before you get locked into a situation and then find out later, wish I would have, right? What's that commercial? I could have had a, right? So, okay, so on reverse mortgages then, this is one of the areas. Now, with qualifying, we talked about FHA. Let's talk about costs on a reverse mortgage compared to, say, a traditional mortgage.
Every mortgage has a cost associated with it. They're going to have third-party fees, which is the cost of your title commitment, the appraisal, all the basic third-party fees that go into every loan, whether it's a forward mortgage or a reverse mortgage. And then the secondary thing is that every FHA mortgage, so reverse mortgage is FHA, it's Federal Housing Administration, every FHA mortgage has an element, as does the reverse mortgage, of a mortgage insurance premium, which means that in an FHA loan, they're lending you money and generally it's a whole lot more than that 80% mark. You know, generally in conventional mortgage, if you borrow only 20%, then there's no mortgage insurance. Well, with the FHA mortgage, they're generally always lending over 80%. So there's going to be a mortgage insurance premium. There's going to be a mortgage insurance premium on the front end of the loan, and then there's also going to be mortgage insurance each month in the monthly assessment of what you owe.
Until you get to that.
And that's the same with both forward and reverse.
Until you get to that equity. Which is where with the reverse mortgage, of course, because you're not borrowing as much, you don't have that expense. Well, how about in terms of origination costs or fees or other things, you know, other than, is there any difference there?
The third part is the origination fee. There's the third-party fees, there's a FHA part, the mortgage insurance premium part, and then there's the origination fee. Up until about a year ago, Hank, we didn't have an origination fee in reverse mortgages. And then the government saw in their wisdom they need to start charging something, and we need to start showing it. Well, between you and me and just us kids, the origination fee exists, and it's a portion, it's a fraction of, it's based on a percentage of what the value of the home is. But that's a number that's kind of negotiable. That's, you know, if a lot of times if I've got a client who's really squeezed, they don't have just quite enough equity to do it, then we'll negotiate on the origination fee to save them some money so they can get into this loan. So
we're going to take a break, and when we come back, I want to get into this costing a little bit more. And basically, the next thing will be comparing interest rate. Is there any difference between one and versus the other? So we're going to get all your questions answered there, and then I'm going to talk to you again. I want to make sure we get into how to pay off your mortgage faster. For those that are leading up to retirement, show you how to save a lot of home interest that you may be paying. So join us here. We're going to be right back on a Retirement Report.